Welcome back to Morning Trade Live. Time now to go inside out on Apple ahead of earnings next week. Joining us now is William Kerwin, equity analyst, Morningstar. William, thank you so much for joining us today. Let's talk a little bit about expectations going into its results. It feels like expectations have started to have a haircut. You're seeing analyst after analyst downgrade their view, although more analysts than not are in the buy camp when it comes to Apple. What are you expecting in terms of performance around the iPhone and revenue?
Well, Diane, it all really comes down to the iPhone at the end of the day. This is still more than half of Apple's total revenues. And the December quarter that's about to print next week is the heaviest iPhone quarter of the year with a new product release and the holiday season. And that's really where we think this haircut in expectations has come, is formerly lofty expectations for the performance of the iPhone 16 with AI have come down a bit. And we think that's reasonable because the AI rollout from Apple has been delayed. It's been protracted. We still don't think the best feature set from AI that they unveiled in June is even released in the iPhone yet. So we think it'll be a good quarter, but a little bit less good than what was expected probably 3 months ago.
Why do you think that the Apple Intelligence wasn't as much of a catalyst as it was expected to be? Do you think it's because of the staggered rollout, or is there something else? Was there something missing that needed to really be the trigger to accelerate iPhone sales of the next generation?
I think the staggered rollout is definitely one of the two, but I think the other main reason is that we have yet to really find a quote unquote killer app for AI on a smartphone right now. I can download a ChatGPT app on my phone. So a lot of this isn't necessarily revolutionary. I think it'll take time for consumers to get used to how to integrate these AI functions into their daily lives. And that's why we think actually the iPhone 17 cycle in 2026 will be a little bit stronger, because consumers will have had a year to see what friends and family are using the AI for, know what use cases they're going to integrate into their daily lives.
That's a good point, because I did think, this is just an anecdote, that I would upgrade my iPhone to the 16, which I didn't do. So I guess I would have been a part of that super cycle. But I know sooner rather than later, I'll probably need to upgrade. And I wonder if there are more consumers like that. But I want to broaden out to what we heard about the numbers out of China with regard to iPhone sales there. Apple took a big hit off of that when we found out that they lost some ground, that we saw sales slow by some 18% there and losing some market share there. How much does that matter to its results?
We think it matters a lot. And this really bakes into our longer term view on Apple's stock, in that with the iPhone as the primary driver, we think there are multiple headwinds to iPhone growth longer term, one of which is China. China used to be a growth outlet for Apple, but now there have been revamped domestic alternatives there from the likes of Huawei, also some national security concerns between the US and China. Apple is still selling iPhones into China, but it is no longer that growth outlet that it used to look for. And then on top of that, we just view the global smartphone market as mature, and it's hard to grow on top of a slow growing or declining mature market like that. So for us, our bearishness on Apple's valuation, where we still see it as moderately overvalued today, really comes down to those longer term headwinds to iPhone growth. And we think if you're buying shares today, you have to assume a rosier outlook for iPhone growth over the next 5 years.
So given you have a 2-star rating, you've got $200 fair value estimate. Do you really think that it will go that far? 63% of analysts have a buy rating on Apple. There's, some in the whole camp, few sells. And when you get the level that it's at right now, it's a little bit higher today. 220 seems to be a support level that I've heard that we pay attention to. What is it that takes it or breaks down that weakness to get to that $200 level that you anticipate?
Well, as you said, we think it's worth $200 a share. And really, we think what the catalyst will be is a recognition over the coming 12 months of this less than super cycle, less than rosy iPhone growth picture. We expect that this AI is driving growth this year, growth next year, after 2 very mediocre years for iPhone sales, either flat to down. But really, we see long-term growth looking in the mid-single digit range, call it 5% year over year. We think expectations are a little bit higher than that. And so we think as investors come to recognize that this growth is lower than previously expected, that'll be a negative catalyst for shares. But again, I would just say at its current level, it's about 10% overvalued versus our fair value estimate. So this isn't a massive disconnect here, but yeah, we do see shares as a little bit rich right now.
Okay, we will certainly be watching this one, and there have certainly been some analysts recently who agree with that sentiment. William Kerwin, equity analyst, Morningstar, thank you so much for your insight and deep dive into Apple ahead of its earnings next week. All right, let's get you set up to trade it with senior markets correspondent George Tsilis. All right, George, I know you've got a couple of example trades for us. Why don't we start out with, on one side, you've got a bullish example trade. What does that look like?
Yeah, so we have to consider the context of the events coming out with Apple. They have earnings coming out next week on the 30th. So with that said, if we're starting to see a little bit of a trend reversal for Apple as we move into earnings, we have to consider the elements of implied volatility, which are higher in the expiration for next week options. So what I'm going to do in this case is rather than just buying an outright call option, I'm going to structure a long call diagonal spread. So in essence, I'm going to go out to next week's expiry and sell an out-of-the-money $230 call. Then I'm going to use the proceeds of that option that I'm selling to help finance the February with 28-day expiration in the money 220 calls. So in essence, this is a two-legged structure with different expirations. You could actually purchase this for about $7 a share or $700 a contract. So in essence, the objective is for the stock to go higher because it is bullish. Your break even, if you do hold this position to expiration in February, is around $227. So the only issue is that if past $230 between now and expiration next Friday for the January contract, you just won't be able to participate past that level unless you close the January contract, on Thursday potentially or even Friday morning. Which, of course, at that point in time, your February contract would be unencumbered for unlimited profitability. So it's a bullish trade, but at the same time, there's a capped profitability if you do, again, see the stock rise above 230 on Friday.
And now, given the context of a lot of the things that we're hearing recently with some analysts becoming less constructive on Apple, what's an example trade for a more neutral approach?
Yeah, so if you're a little bit more neutral, I mean, looking at the chart, first off by Apple or for Apple, it seems to be getting closer to its 200-day moving average. So that's typically an institutional level of support. So with that said, if it does fall a little bit further, we can structure a neutral to bullish trade that allows us to participate if it does slowly move lower, but it may end up holding that 200-period moving average. So I'm going to go out to February again in this case, so we don't have to deal with the earnings volatility. And I'm going to sell the $215 cash secured put. And the reason I selected that strike price is that $215 corresponds to the 200-day moving average, but it also suggests we're selling a implied delta in that option of about 30. So it implies basically a 70% probability that it will expire out of the money, and we could sell this option for about $3.50 a share. So in essence, gives us flexibility for the downside. Ideally, if the stock does fall below 215 by expiration in 29 days, you would be assigned shares. So, but your break even or your cost basis is $211.50. So in essence, if you're willing and able to take ownership of the stock at $215 with a cost basis of $211.50, this is certainly a trade you could consider.
All right, George Tsilis, senior markets correspondent on the Schwab Network with an example trade for Apple in both neutral and bullish take.